All right. Welcome everyone to this session of the Yale ICF, where we're going to be talking about DeFi and regulation. I'm super excited to have two fantastic speakers with us. My name is Diana. I am a 2017 Yale SOM alum, and I currently work at a boutique investment bank that focuses on blockchain, crypto, and ESG and sustainability. Previously, I wrote a book about the intersection between governance and sustainability and blockchain technologies. I've advised some regulators, and I've been in the space for a few years by now, and super excited to have these two amazing speakers. We're going to have a great conversation. So first of all, getting started with welcome, Tim. We have Tim Swanson, who is the head of market intelligence for Clearmatics, and he's also the founder and director of Post Oak Labs. And he also started a DeFi protocol of his own called Tau Protocol. And he's written extensively and spoken extensively across the space about market infrastructure and DeFi and blockchain protocols. So he has a wealth of knowledge. And we also have Alexis Goldstein here. Welcome. She is a financial policy director for the Open Markets Institute, and she has a wealth of experience as well on Wall Street, particularly being involved with a lot of technology integrations, financial regulatory policy, and has been featured. Her writings and her speeches have been featured in the New York Times and a number of other media platforms that are very well known. So welcome, both of you. Let's get started.
Thanks for having us.
Yeah. So first of all, we're going to talk about decentralizing finance today. So what are both of your thoughts on why decentralizing finance? What are the frictions of the intermediated system that we have today? And basically, let's start with the system today.
Well, to be fair, a lot of the talk around DeFi is, and this is, I think, how Alexis and I bumped into each other. It's typically centralized in some manner. So I'm not here to just throw cold water on everything, but there's I think the term CDFI comes out, which is a kind of centralized, decentralized finance, which is an oxymoron. And I'm not here to promote a single platform or protocol, but I guess if we give a generous interpretation of DeFi in its genesis, it has to do with, broadly speaking, power centers, these intermediaries in traditional financial systems globally that have created either monopoly or oligopoly structures and extracted rents from that, creating a variety of different knock-on effects we call moral hazard. We can also talk about that's from the business side or political side. From the technological side, I believe a generous interpretation of at least the ethos of a decentralized financial network or system has to do with the resiliency or reducing the single points of trust and single points of failure. Again, those are the aspirations. I'm not necessarily saying that that's actually occurred in reality.
Exactly.
I'll just offer maybe a few examples, since that's obviously a big question, but maybe some that have been in the news this year. When we think about intermediaries in the sort of so-called traditional financial system, I think payment for order flow is an interesting thing to think through that has been talked about a lot, right? So you have the sort of large broker dealers, you have some large institutional, typically facing broker dealers. Then you have the sort of somewhat smaller retail focused broker dealers, but there is this arrangement known as payment for order flow, where a market maker can pay a retail brokerage a preset fee for every trade that they execute. And there's been a lot of questions, both historically and this year, around Robinhood and various other retail brokerages about whether or not that creates potential conflicts with the broker's duty of best execution, which is a legal mandate that requires that brokers get the most advantageous order execution for their customers. And so there was been a lot of sort of talk about where some of these retail brokerages had been sending their flow and whether or not that was in the best interest of their customers and whether their customers were getting best execution or if that was in the best interest of the brokers and their revenue streams. And, different market makers might have been offering them, premium payment for order flow in order to get their flow, which was sort of profitable for them, but maybe disadvantageous to the customers themselves. Another one that comes to mind is like some of the biggest broker dealers out there tend to employ interdealer brokers. So not only are these they're these major players that tend to eat up a lot of the institutional business, when they trade with each other, tend to utilize an intermediary known as an interdealer broker in order to do the trades with each other. And one other thing that I tend to think about that sort of just to throw in as well is there's sort of like power concentrations in all of those, but then you throw in things like market data. And, are there particular private entities that sort of have a corner in the market data, right? I think about the Bloomberg terminal and how dominant that is in terms of supplying not only market data for listed markets, but especially market data for over-the-counter markets. It's really one of the really very significant dominant players in market data in the larger banking system. So those are three examples that come to my mind.
Absolutely. That's fantastic. And like we see in our intermediated system that we have today, there are implications eventually on systemic risk from centralized systems when risk is concentrated into single points of failure. And what can the alternative provide when we have an emerging system that runs on the blockchain? So when we think about DeFi as an alternative, and a lot of DeFi protocols precisely propose automated market makers to deal with some of the issues that Alexis just mentioned. Can we explain a little bit more of what is the DeFi tech stack? How do you define DeFi and what's it doing?
Sure. And actually, if you don't mind, if I kind of step back real quick and just talk about the utility that financial market infrastructures provide. So as Alexis mentioned, you have these interbroker dealer types of facilities, types of organizations, types of institutions globally that provide something that's useful to at least these parties. Maybe we could argue what level of social utility there might be. But if we look at like how the principles for financial market infrastructures, how they divide, like when the BIS and IOSCO, these two international organizations, how they kind of sliced and diced and categorized organizations. You had the CSDs, the central securities depositories. You had the CCPs, or the clearinghouses. You have payment systems, which are basically run by central banks. They're called RTGSs, real-time gross settlement systems. And we could go on and on. There's, I guess, 6 or 7 main categories here. And so if we look at in the background, these provide enormous value to society because of the assurances they provide to the capital markets, and not just to, for example, people think it's stock trading or bond trading. There's a lot of other stuff that goes on in the background. We would consider fairly boring. It's very mundane relative to the quote unquote exciting retail consumer focused applications that the DeFi world is always talking about. But when we talk about like the DeFi stack, what is that? Well, you have some, I guess you call like the aspiration is to somehow decentralize all the utility that's overseen by something like the BIS, or I guess in the more germane would be the Financial Stability Board. What do these large intergovernmental international organizations look at? Is there a way you could actually decentralize it? And I think that there's the evidence is thin at this stage. You certainly have a lot of attempts at it, and the question is well, I guess there's a number of questions, like how or why would existing financial intermediaries want to participate in that? Because in a number of countries, they have a moat around the utility they provide. So for example, in the US, the DTCC is the only entity that provides basically the settlement of securities in a given day. In most countries, there's something similar to a CSD or exactly a CSD. So even if the DeFi world supposedly built something where securities could be cleared and settled somehow legally and technologically, at the end of the day, you still have to have securities in most jurisdictions, including the US, settled through specific types of facilities. It doesn't necessarily have to be the DTCC. There's other systems that allow you to individually settle stocks. I know that entities like Paxos have been approved to provide settlement for certain types of instruments. So it's not that DTCC is the only going to be, will be the only game in town. It's just broadly speaking, that's where the equities are settled. It's actually in New Jersey, believe it or not. So I'll pause there and see if Alexis had something she wanted to jump in with.
The only thing that made me think of, Tim, was that you sort of talked a little bit about like, well, I feel like you were leading us maybe towards fragmentation and in the future, perhaps, is what I was thinking about. But there's pluses and minuses, right? Obviously, to the existing system. And I think there's like some different thought about how to change it. But one thing I think that perhaps is a plus of the existing system is there is like a consolidated data feed where we know like the quote on this exchange is going to be the same as the quote on this other exchange. And there's some like ability to have certainty about that. Which is not what you were talking about, right? You were talking about settlement, which I feel like you're right. Like that's the thing nobody really wants to talk about. It's not like the most exciting thing, but it's so important, right? Yeah. And I think we saw that this year with some of the volatility and the sort of GameStop trading, and when Robinhood had to raise $2 billion worth of capital, right? Like if you don't manage your capital well, like it can be really bad, but nobody tends to sort of get into finance very excited to like be a quant that manages somebody's capital. But it is obviously like a really important thing, even if it doesn't necessarily garner that many headlines.
Absolutely. In fact, yeah, you just raised a couple interesting points. So the counterparties in these large trades are settled through actually fewer organizations today in 2021 than they were in 2008. What ended up happening post financial crisis is you had a variety of G20 meetings. The first took place in, I believe, in Pittsburgh in 2009. In which the regulators are like, hey, you have all these over-the-counter derivatives being traded. We don't have optics. You hear the notional values of these big numbers, but we don't have optics into who's involved in all these trades, or we have no scope on the systemic risk that these instruments are putting on society. So why don't we just use existing clearing facilities to have this all traded, or at least in this case cleared? There's trades already takes place as post trades of clearing processes. And so to the happiness of existing intermediaries, they got more business, but we actually ended up concentrating risk in the same types of institutions. And so as a result, going back to that word that nobody likes really talking about, at least deeply, it's the systemic issue. If these institutions, this handful of institutions blow up somehow, you have reverberations. I'm not saying that it will blow up. There's obviously lots of stress tests that take place, but the idea with the DeFi world, at least the proposal that a lot of these the original projects was like, hey, how can we at least not only reduce the moral hazard involved in bailing out these types of too big to fail systemically important financial institutions, but how can we make it such that you have a much more resilient network and you spread out that power amongst players? And we could talk about whether that's been successful so far. And I would say that it's definitely a work in progress. That'd be the most generous term, because you typically have high concentration still in certain intermediaries. But we could talk about that in the second part.
Absolutely. No, those are very, very important topics. And where do you think we stand now in terms of our progress, given the DeFi stack that exists today, and what has it accomplished and what hasn't it accomplished?
Yeah, I was just messaging Alexis about this yesterday. So we haven't actually defined what the stack would be, and I guess just real quickly, I'm sure people will comment saying I'm horrible for leaving certain types of apps out, but you need to have some kind of, for the blockchain world, you have to have a blockchain somewhere. And I'm not saying you need to have a blockchain like in general. I'm just saying for the DeFi stack, you need to have some kind of blockchain, conceivably, that can run some kind of or utilize some kind of smart contract. We could argue about what the definition of smart contract is or is not, but what this second set of layers are, and it's not, there's this term called L2, and that has something else on the infrastructure side, but you have dApps that run on top of these centralized apps that supposedly run on
centralized apps.
Yeah. So, and you have price feeds going into it through these things called oracles. So you could, the contract knows when something is done or when an event is being triggered. So I'm sure Alexis could talk to us about, the history of some interesting ways of abusing that, and there have been examples of Oracle failures recently, but that's not the topic of today. And instead, if we look at what has happened in terms of popularity and then meeting with running right into the traditional financial world, is there's a interesting aggregator called Oneinch. I've used it several times in the past because that's where you typically get some of the best pricing for any of the swapping execution on Ethereum. Although I guess it's multi-chain at this stage. But they just announced in the past day that they're going to geo-block US users, and it brings up how and why, and it's a front end issue. Obviously, there's someone runs a website, someone maintains a user interface that allows people to actually do these swaps. So if we're talking about the aspirations of enabling anyone anywhere to trade financial instruments or some kind of digital asset, it's running hard into now the stark reality that regulators and law enforcement, whether you like them or not, are going to say, hey, if you're in the US or specific some other country, we're going to say you can and cannot do these things. So you can fight against it. You could say you hate it. That's fine. I'm not here to say, proposing what I like or not. I'm just saying that that's something in the first instance is a couple months ago, Uniswap, which is probably the best known AMM on Ethereum. They announced they were delisting. It was like 129 different tokens. It was from the front end. You can still access it from a different front end. It was from their official front end. There's other ways you can still access those trading pairs if you use a different type of front end. But
right,
these parts of centralization, these areas of centralization are still part and parcel to this world of DeFi.
what about the regulatory landscape?
Sorry.
And here I'll turn it into Alexis. Technically, DeFi in many ways is still questionable whether it's still outside of the legal regime, and there's still a barrier for adoption for banking entities. What do you think, Alexis, in terms of the progress that regulators have made in the space?
So I guess the best thing we can do is just sort of turn to public comments that we've seen by regulators. There's obviously been a lot of movement internationally. Maybe we can talk about that later too. But here in the US, back in the summer, there was a speech that CFTC Commissioner Berkovitz gave in June. He's now actually he's now at the SEC, but he was at the CFTC as a commissioner at the time. And he was talking about how it doesn't matter if you're decentralized, if you are trading derivatives on a decentralized platform, a centralized platform, you have to abide by the Commodity Exchange Act. And so you might need to register with the CFTC under, as a DCM or, a futures, merchant. You need to obey what the CEA says, regardless of if you're decentralized or not. And a point that he made, and I forget if it was in this speech or in a subsequent one, he gave a speech at a DeFi conference, but he was sort of talking about how it's not just unlawful to enter into a contract on an unregistered exchange. It's not just unlawful for the exchange to do that, it would be unlawful for the individual to enter into that contract as well. And he made the point that traditionally the CFTC didn't go after individuals, they went after entities, but he was talking about it in this broader context that it may be, there may be some hesitancy on the part of, banking entities because of that to go into DeFi, right? Because they're not going to want to enter into contracts that may be unlawful. And so that was something that Berkovitz pointed to over the summer. Just to sort of jump back a minute to what Tim was talking about with Oneinch, that I think is interesting. So this seems to just have happened yesterday, right? But there's this prompt, and then there's this attestation, this sort of like digital attestation that they're asking you to sign to say, that you will not use a VPN, that you will not try to evade.
Right.
And when you sign that, if I understand it correctly, it goes on to, it's recorded on the blockchain. And so it seems to be this effort to sort of push the compliance onto the user and off of the firm. And so I just think that's sort of interesting to note. It's sort of like, we're not responsible for the legality of this. You as an individual user need to manage that for yourself. And then I think, obviously we've seen a bunch of different international actions. I mean, I think the China one has been well discussed. We probably don't need to discuss it here.
Why don't we review it real quick for people who are newer to the space?
Oh, sure. Well, so I think there's been a lot of actions in China that have sort of, happened over many months, but the most recent one was they sort of published this notice that had a lot of very specific prohibitions, I think perhaps a little more specific than they've said before. So I'm not going to read all of them, but I'll highlight a few. Virtual currencies does not have the same legal status as legal currency. Virtual currency business activities are illegal financial activities. Financial institutions shall not provide services for virtual currency related business activities. Neither can internet companies provide services to virtual currency business activities. It's pretty comprehensive. And
China's really cracking down on all the virtual currency activities and often in support of their own central bank digital currency version.
So there's that most recent thing in China, but then we've seen various other things over the summer. There was Hong Kong Securities and Futures Commission warning Binance specifically about their tokenized stocks. They said they are likely to be securities. There was warnings by Germany basically saying to Binance, if you're going to do tokenized stocks, you need to give people certain disclosures and prospectuses about the stock that you are tokenizing. The UK warned Binance that they were not registered. It's not just Binance, but that's what's on my list here that I wrote down. They voluntarily left Canada because Canada's Ontario Securities Commission took legal action against 3 different crypto exchanges, KuCoin, Bybit, and Poloniex. So anyway, there's like a lot happening, and I think that may be perhaps related to the thing that Tim mentioned about Oneinch, right? There's sort of a lot of different action happening internationally. And I think the entities are sort of in some ways perhaps pushing the burden of compliance onto the user, at least in this Oneinch case.
Right. What about with the latest developments, especially on the institutional side and with the DTCC having approved Project Ion and what that means for a potential decentralization of finance development. What are your thoughts? And could you expand on what it is?
So it's funny. I got trolled the other day, I guess a week or two ago, by some people saying, "Oh, there's no financial institution that's looking seriously at using an actual blockchain." And I was like, "Well, here's a press release from the premier CSD in the world. They handle all this stuff, and they're supposedly taking it really seriously." Unfortunately, the press release and stuff like that had in the actual PDF form didn't have a whole lot of details. So rather than reach out to them, these guys just yelled at me as shooting the messenger, right? In general, most of these intermediaries have looked in the past at doing something with a blockchain for a variety of reasons involving really boring post-trade processes, primarily around like reconciliation. I don't think a lot of people realize that it's not just like one server run by one organization and then you have like a little army of people with guns like protecting that server. That's not how like the financial institution, like the system works. You have hundreds of servers from just like one specific institution that are run through different data centers. Now, I'm not saying it's just like duct tape and stuff like that, but it's a lot of, I hate calling it band-aids, but like the entire system of electronic trading and electronic settlement dates back to the mainframe era in the very late 60s and the early 70s, in which you had people on bicycles. After trades were done, at the end of the day, after everything was done in 4:30 or 5 or whatever it was at whatever trading venue, people would literally like get the messengers, the couriers, give them the certificate saying, "Hey, let's go to the clearing or settlement area." And they just went down the street, and these were bearer certificates in some cases, and they get lost. And so if we're going to talk about like how financial market infrastructures exist today, we have to look about like why they were set up that way. And it wasn't purposely trying to be belligerent in creating reconciliation problems. That's just the nature of how organizations were set up kind of off just organically and put together in a very, I guess we would call it inefficient manner today, or maybe a gross manner. Like this is not elegant, but all normative all subjective views aside, the organizations like DTCC have been very early, relatively speaking, talking about doing something with a blockchain, in part because of what you talked about earlier with capital allocation. So the push to have something like U.S. equities settled, currently it's T+2 days. So it means if you trade today, in 2 days you'll have the cash or the instrument or both. It'll have gone through their system. So what takes place during those 2 days? You had a lot of people and organizations for a decade plus, especially in the fintech world, trying to do trade compression, liquidity management, collateral management. There've been a lot of, hundreds of millions of dollars raised basically every year to try and make the liquidity slicing, as it were, in a more efficient manner. And I'm not here to go through all the nitty-gritty, like whole life cycle of how all that proceeds, but I can only speculate at this stage what the DTCC plans to do with Project Ion, assuming it actually goes live next year.
Right. There's a real case for clearing and settlement, and recently we've also seen the case of Bitfinex having spent $2.3 million in fees for a single transaction, right?
23 million.
What does that mean? What does that mean for in terms of risks in the DeFi space? And probably Alexis, you have.
Yeah, so this is an interesting one, right? Because I think some of the things that are perhaps trying to be solved for, you try to solve for one problem, sometimes you introduce a new problem, right? And I think this is I feel like we don't quite know exactly what happened. I mean, we've seen what's been reported. So Bitfinex was attempting, as I've seen it reported, Bitfinex was attempting to transfer $100,000 worth of Tether to, and now I'm of course going to forget their name. It's like a DeFi platform. Does anyone remember what it's called? Diversify. Thank you. And it's unclear what happened, if somebody fat fingered the, Ether gas fee, if there was some issue with the service itself. I personally haven't seen reporting about that, but they paid this, at the time, $23 million, Ether gas fee to move $100,000 worth of Tether. 10 hours passed. The miner was like an unknown miner. It wasn't a miner who was like a known, mining pool or anything. And then 10 hours pass and the miner gives back almost all of it, but not all of it. They retained something like,
I think they gave back 22.
Yeah, it was like between 800,000 or $1 million worth of ETH that they kept, but they gave back the majority of it. And I think it's sort of, it shows that there are pieces of the, DeFi that do have fragility, right? And it's, again, I don't know that we have enough information to totally diagnose exactly what happened or what went wrong, but there are certain incentives, right? Miners have incentives to extract value from all of these transactions. There are incentives perhaps for people to, Tim, you and I were talking about this yesterday, right? Do miners who didn't get that fee now have an incentive to perhaps change the way that they do business to try to, up their chances of getting such an accidental fee in the future? And so I think sometimes, you solve one problem, you create another problem sometimes.
It actually ties in with, I'm not sure if the listeners or viewers have followed the traditional financial markets, but there was a trader at Citi who tried to send, I think it was about $8 million to a series of lenders through Revlon, I guess a couple of years ago, and accidentally sent about $900 million. It went to court, and the judge ruled earlier this year that they're not going to reverse that. That was, even though you say you make a mistake, we have to have settlement finality. Like that's the gold standard. We can't reverse that kind of thing. So you have to live with your mistake. So Citi, instead of paying $8 million, ended up having to spend about $900 million plus whatever court fees, obviously. But this whole idea of irreversibility is part and parcel to, for example, the payment system in the US through Fedwire. You can't reverse the transactions, and that's on purpose. That's a feature. And so it's interesting that a lot of the cryptocurrency enthusiasts, and for what it's worth, I'm not anti-cryptocurrency whatsoever. I work for a company, building blockchain related things, and we could talk about hopefully more in a couple months. But one of the advertised or marketed features of a blockchain has always been, at least in the public public chain world has been, oh, these things are irreversible, they can't be changed. Like, all right, well, why are miners, I'm not saying miners shouldn't return fees, but it's interesting in this case, $24 million transaction fee, as it were, is roughly 55% of a daily income aggregate of if you add all of the block rewards at current market prices for Ethereum, it's about $40 million a day. And so $24 million, that's quite a bit of payday. So why haven't miners collectively or individually tried to aggregate enough hash power to do reorgs to capture that transaction fee? I mean, we could speculate that on this call, but in the real world, we still have, at least in the US, courts that uphold the whole principle of settlement finality.
I will say though that there is, I think, other risks perhaps of like the immutability or the irreversibility that I feel like are a little bit unique, because I think, you mentioned that particular court case, it happened to go that way. I don't know that it will go that way in every case. And if we think back to the financial crisis and we think about AIG and their contracts with Goldman Sachs, like they were able to negotiate in the midst of the crisis and sort of negotiate down the amount that they had to pay, even though they had a contractual agreement, right? Because this was all happening in the context of the crisis. If the AIG contract with Goldman Sachs had been a smart contract, I think you could make a pretty good argument that the crisis might have gotten a lot worse if that had auto-executed. And so I think sometimes, having frictions isn't always the worst thing in the world, depending on the circumstance that we're talking about. There may be instances where at least having the ability to have some negotiation back and forth and things not auto-execute may actually be preferential in times of like extreme volatility or crisis like that.
Mm-hmm. Exactly. I'm going to say that to the audience, we do have questions that a lot of you submitted when you registered. Feel free to ask further questions as we speak, and we'll address them as we move forward. But that being said, maybe a question to Alexis and also Tim. What do you think needs to happen for regulations to develop in the right ways?
I mean, that's a big question. I think there's a lot of existing regulatory frameworks that a lot of this stuff likely falls under, right? Like we have securities laws, we have the Commodity Exchange Act. One thing that I do think is interesting is right now the market is very fragmented in terms of market data, right? Like you're reliant on the exchange sort of providing whatever market data they're making public, and it's different than this other market. And it's not like the stock market, right, where we know the quotes we get, regardless of where we're looking, they're going to be the same. And that might be something that Congress or policymakers might want to think about, right? Is there, because that does seem to me to introduce potential for market manipulation and arbitrage opportunities. And, it may be difficult for an individual retail investor who doesn't have a fleet of programmers, at their disposal to sort of like figure out, what the right market data is. And I think that the space is big, and obviously like there's always a question of regulatory funding. So I think that's always a good thing, right? Like when I testified before the House Financial Services Committee about a totally unrelated issue, I sort of, pointed out that I'm sure the SEC could use some more funding to do, GameStop related investigations and things like that. So I do think as this and other markets continue to evolve, that is always going to be a helpful thing for everybody to wrap their head around it.
Yeah. That does relate to one of the questions that we got on what incentives do regulators have to accept decentralized practices or blockchain. And maybe here we can also talk about governance tokens and the existence of tokens and consortia practices and the different formats of organization. Maybe Tim, you can have some insight on that as well.
I think the pre-call we talked about consortia stuff. So at a high level, consortia for at least the past 6 years have really struggled more or less because of not due to a lack of imaginative or creative use cases between partners. I'm thinking specifically around banking consortia that were from 2015, 2016 era. I previously worked at R3. So, you have 100+ use cases presented by, Barclays or Bank of America, saying, hey, we could do these things. And again, these aren't cryptocurrency related projects per se. These are all this again, this post-trade related activity that you and I typically don't see in a given day. So I would say that the biggest hang up or hold up for some of those use cases in that era was a lack of a settlement asset that parties could rely on that didn't have the counterparty risk of another commercial bank. So they needed something like a central bank digital currency. I'm not saying that you have to have a blockchain for a CBDC, or CBDCs are great or anything like that. I'm not here to promote that. In fact, there's many different models. If you just type in money flower diagram CBDC, you'll see that at least in 2018, 2019 era, there's already 5-6 different proposals that were kind of in the running. And the organization I work for, we spun off another company called Finality that's deep in the weeds of that world. So I'm not saying I'm coming here on your panel to say policymakers approve a CBDC. I'm not saying that at all. I am saying though that if we look at the uses, at least at the sell side, the banking side had during the 2015 through 2018 era, it was all hung up, not all hung up, but primarily hung up on the lack of a neutral settlement asset from something like a central bank.
Can I ask, Tim, I want to ask you a question, if that's okay, Diana, just because I know you've written about this, is I feel like one of the things this space could use is like some agreement on nomenclature. Like, I feel like there's a little bit of like, we all know what we mean by DeFi, but like one question I have for you is there's sort of like this notion, I think, of a public distributed ledger and a private distributed ledger. And like, when we say blockchain, do you have thoughts on like what we actually mean by that? If you have like a private distributed ledger that's just used by like 3 different big entities, but nobody else, like, is that a blockchain? Like, I'm curious if you have thoughts on that. That's a question I've had.
Sure. I mean, to be pedantic, you could take something like Satoshi built and put it in the 4 walls of someone's organization, and you can still call it technically a blockchain. Whether it provides the utility of what Satoshi designed, or what Ethereum or these other public chains did, that's a whole nother conversation, I think. At the same time, that's not obviously the reason why large banks were looking at this in 2015, 2016, and even to today. Every single bank that was involved early on in R3 has gone on to build other business lines around cryptocurrencies per se. That again was infrastructure, having a shared infrastructure in which not a single participant owned. And the struggle came around governance as well. So like you'd have fights over, okay, so if we build an equity model, then is it the person who owns, or the bank that owns the most equity, that gets to have the most votes on the architecture? So unfortunately, those weren't necessarily resolved. What you ended up having is a re-intermediation. And what I mean by that is, if you look at, say, like the 10 or 12 companies that receive, the prominent companies that receive any kind of financial, like formal financial backing, so like the DA, Digital Asset Holdings, R3, those types of companies in that time frame, they ended up re-intermediating themselves. So they came up with some kind of vendor lock-in. And I'm sure I'm going to get some angry emails from people. I'm not saying that's to say that these are evil people. I'm just saying the business model ended up triumphing over any of the technological stuff. So obviously I'm going to get some strongly worded emails from former colleagues in a second here. But like, let's be honest. Like, if you create vendor lock-in, either through licensure or through some kind of gating process, then you're really negating the use of having one of these types of blockchains or distributed ledgers, or whatever you want to call them.
I do think that would be a big challenge, just speaking as someone who did used to work in banking, is getting everybody to agree on a certain governance structure. I think there's sort of a competitive approach that would sort of work against that, and that would be quite a challenge. Like maybe taking it to something that just happened yesterday that's in the governance space, but not related to like, the big mega banks, is this compound situation where they seem to have voted on a change to the distribution of their rewards, and there was a bug, right? And some people got, it looks like, billions of dollars worth of comp tokens. And I don't know if the reporting is correct, but it seems to be a very small error in the code, right? Like a greater than instead of a greater than or equal to or something. And I feel like that's another challenge, right? Because it seems to me, if I'm understanding it correctly, that their governance process requires them to basically wait 7 days to implement the fix for that, right? And that's an interesting example, I think, of how there's pluses and minuses, right, to working in a sort of like distributed like governance structure, right? Like it may be more collaborative, but you also it might take you longer to implement changes even when something really drastic happens.
Yeah, so on the face value, governance tokens are kind of promoted as some kind of more democratic solution than voting by hash power through signing the Coinbase transaction or something like that. In practice, you have, obviously issues like you just described. You also have kind of plutocracies form or oligopolies in which the rich get to determine, because you typically have a threshold of X amount of coins needed to vote. Again, I'm not saying all these guys are bad or horrible. They're trying something. I'm not de-endorsing necessarily the idea, but in practice, yeah, you end up. They tried it, right? Compound like legitimately said, "Hey, okay, community, you want to propose something?" So some guy proposed a change, and then they hired some other one to actually independent guy to like write the code, and they paid him, and then it turns out that the code had, like you said, the small bug. So I'm not A for effort, I guess, but like obviously execution. There's I'm sure some funny lines from Dr. Strangelove about the plan was okay, it's the execution of the plan. There's some human faults in that. So again, the Soylent problem. If you ever do this type of show or panel again, a guy named I forgot his last name, Steve, out in California. Obviously, it was like a million Steves, but I'll find his name. He wrote. If you type in Steve Soylent blockchains, he mentions how like this is like 6 years ago. At the end of the day, blockchains are run by people. So even as automated as they are, you still have to depend on the human error factor.
Yeah, there's a concept of counterparty risk in financial services, but then in the blockchain world, a lot of it gets translated to smart contract risk, right? Because smart contracts have vulnerabilities. There are hacks, and how do you account for those risks?
Well, and an interesting hypothetical I saw raised by Nicholas Weaver, who's a computer science professor at Berkeley, who wrote about the Poly network hack, where basically somebody seems to have figured out how to tell the smart contract to give it all or her all their money, right? And then it did. And the sort of tongue-in-cheek thing that Professor Weaver mentions in the blog post about it at Lawfare is like, is that even a hack? Is it even like illegal?
What do you consider that?
Right? If it's there in the smart contract,
yeah.
and you tell the smart contract to give you all the money and it does, like, is there a problem? And they had this whole long negotiation with the hacker, who they at first started by telling them they would call the FBI on them. And then they started calling the hacker Mr. White Hat. And then eventually the hacker returned most of the money, or all of the money, or almost all of the money. But it is sort of tricky, right? Like there's this, I feel like the burden there was this attempt to like, if we use smart contracts, we don't need lawyers. But it seems that you may have replaced lawyers with programmers. You need a really technical, like good programmer to read the smart contract and make sure there isn't an error in it.
And that was the argument of like code is law, code is not law. In the end, I don't think code is not law, and it can't overwrite. But anyway, that was the whole argument, right?
But what happens in this compound case, right? It seems like, I don't know, are people going to give the tokens back? I mean, I guess we'll see, right? But I think it's sort of a case by case basis how it all works out. And anyway, interesting questions.
Yeah. Well, we do have a question also from the audience talking about precisely for Alexis regarding your comment on Commissioner Berkowitz's view on CFTC enforcement history with regard to investors as opposed to issuers, sponsors, and platforms, if you could expand on that.
So I'm just going back to the speech. So there were two speeches that he gave, and I believe the one that I was referring to was at Solidus Labs. They had a DeFi conference in July. And so this is up on YouTube. You can watch it. But he was talking about, I'll just quote from it. Because businesses and consumers and major financial institutions aren't going to be able to trade or won't want to take legal risks of trading contracts that are unlawful under our statutes, there's going to be, and now I'm not quoting him, I'm just speaking, but there may be barriers to entry for large institutions for doing that. And his point earlier in the speech was that, quote, the Commodity Exchange Act and our regulation don't just make it unlawful to trade a futures contract not on a registered market. The contract itself, it's unlawful to enter into the contract. The participant who is entering into the futures contract that is an illegal contract. So his point is, if you are a DeFi exchange that has some sort of derivative that would need to be registered with the CFTC under the Commodity Exchange Act, and they are not registered, then the contract itself is unlawful. But I can share the link with you, Diana, and maybe if there's a way to put it in the chat.
Yeah, I do a write-up on this webinar, so I'll include it in the blog post after.
Yeah, it's a speech worth watching, I think.
Okay. Yeah, that'd be great. And then another question, when we talk about financial inclusion and turning it to emerging economies, where there is a widespread use of physical dollars, what do you think is the usability for adoption for any sort of blockchain related currency, and where would this fit? Think of Africa, Latin America. My first thought is think of the concept of what El Salvador did, but would love to open it up to your thoughts.
Yeah, I don't think you need a blockchain at all for financial inclusion. I think you have roughly 70 countries that have RTGSs. So if the goal is for people to enable everybody in your country to have access to I guess you could say the safest money domestically, then instead of having to deal with commercial banks, which are intermediate that process, you could provide accounts directly, like effectively retail accounts with the central bank. There's been, even in the US, there's been an attempt to kind of push that through an effort called Fed accounts. And obviously there's a lot of political pushback, not just from commercial banks, but from other special interest groups. So I'm not saying that's a easy slam dunk it's going to happen, because obviously the Overton window, depending on the country, is different. But I don't think, number one, you don't need a blockchain for financial inclusion in general. I've been on like 30 different panels related to financial inclusion, and I've not necessarily been on panels, but like I've seen these experts talk about it, and generally speaking, people on the ground in these countries say that there's a lot of other issues in developing countries that come before any kind of technological solution needs to be proposed. So private property recognition, or not even private property, but just like the rule of law. So like, can you go to court and have a judge provide an equal ruling, irrespective of class or religion or whatever it is? And so again, I'm not here to do some kind of social justice speech. I'm just saying, like, if people truly are interested in financial inclusion, coming at it from a tech only, especially a blockchain centric point of view, I think is the wrong way to do it.
Mm-hmm.
What about you?
I'll just add that I think it's in, I think, pretty much everywhere except El Salvador, you still need to use the existing banking system if you wanted to use, crypto as a mechanism to try to boost financial inclusion. And so until that, isn't the case anywhere other than El Salvador, you're still going to have to, the on-ramp and the off-ramp for crypto assets is still the banking system everywhere except El Salvador. And so I think that's sort of makes it a non-starter right now.
Yeah. First of all, to give a quick step back, a couple of months back, El Salvador approved Bitcoin as legal tender, and there are a number of initiatives to be able to use Bitcoin to pay for your cup of coffee for local merchants. And El Salvador also uses the US dollar as its currency. So it's not like it would launch a central bank digital currency, because it already uses the US dollar. And as it transitions to, at least shows an interest in using blockchain for its daily transactions, it allowed Bitcoin. But there's a lot of implications to that. It's not as immediate or as simple. Yeah. Maybe another question from the audience, saying, how can we apply DeFi to stock markets? I think we covered a lot of that, but if there's anything else you'd like to expand.
Sure, and I'm not endorsing these guys whatsoever, but if you're looking just from a technological standpoint, how could you build something where you do trading? Because remember, when you submit trades to a stock exchange, they do matching of these orders, and then they spit it out to the post trade. Literally, like everything I just said is like definitionally like that's how these things work. And the post trade is all this boring processing I was talking about, the clearing and settlement, that no one really has spent much time looking at, like how that glue is held together. I mean, there are some people who have, but I was going to say, generally speaking, most DeFi panels that I've seen in the last couple of years, they don't spend much time explaining how that how those intermediaries work. They just assume that the trade is the settlement. And what that means, there's actually a slogan, I think, from T0 saying the trade is the settlement. Like as soon as you trade, it's settled and it's done. In traditional financial markets, that's not the case for a variety of reasons. And we don't have time to go into all of them, but can you technically create infrastructure, decentralized infrastructure that enables people to trade something like some equities on a traditional stock market? I suppose you could. The closest example I've seen, in which you have say like a central limit order book providing that utility, is something called Serum. It's on Solana, and if you try to build that on top of say like Ethereum, gas fees alone would be, I think I was messaging Vitalik a couple of weeks ago. It's like 150,000 Gwei or something like that. Again, this is his estimate. I'm not saying that's the right estimate. I'm just saying, like, trying to execute these on top of other blockchains in their current state would be just very prohibitive. You couldn't really do it except for like a couple really wealthy people every day, kind of thing. So I would say that it may not be the best use. I'm not here to judge everything, but from the technological limitations, most chains probably aren't a good fit for that.
Mm-hmm. Mm-hmm. And turning it toward consumer protections, we've seen a lot of recent commentaries, especially from Gary Gensler and the SEC, on the need for consumer and investor protections. What do you think these protections would look like for DeFi and for regulation?
Well, I mean, I think there's a lot of existing, the SEC has a responsibility to protect investors in the marketplace, and there's a lot of existing, rules and regulations that govern that. For example, if you are offering, particular products to customers, you need to register with either the SEC or the CFTC, depending on what kind of product that you are offering. And so this is why I think we've seen some questions around tokenized stocks, which may be security-based swaps, which are already under a regulatory regime that came out of Dodd-Frank. And so, when you offer a security to a retail customer, you have to provide a bunch of disclosures, you have to register, like there are all these rules that you have to follow. And I think that's sort of some of the discussion that we're seeing play out today. But I think the reality is that we have securities laws. They are not new. They are pretty well tread, and they apply to a lot of different things, right? They don't just apply to stocks, right? They apply to anything that you really are offering with that is some sort of an investment vehicle, right? That you might like make a profit or make a loss on. And so I think that's sort of what we're seeing play out, is we're just trying to say, look, if you are a security, you need to come register. And then there's obviously a lot of debate about what is and isn't a security.
Excellent. And then another question would be, when we talk about traditional banks and compare that to the demand for higher yields offered by DeFi protocols, what would it take for that to become mainstream?
So I'll take a whack at this one. They're probably referring to Coinbase's proposed product called Lend. It was being marketed to provide about 4% annual interest if you deposited something called USDC, which is a stablecoin, or it's marketed as a stablecoin. And then they got pushback from the SEC, who sent them a Wells notice, and the CEO and the CLO both went public saying, this is not fair, blah, blah, blah. They go on, read their words. I don't want to put words in their mouth, but the reason banks don't offer, at least in the US, very high yields, because they're not allowed, like they're only allowed to do certain things with your deposits. And I certainly don't want to come on this on your panel pretending to defend the status quo. I don't own any equity in any financial institution. I don't have any personal direct ties to any financial institution at this stage. But like the reason why basically the banks offer deposits 0.5% or 0.05% or whatever the yield is right now for some of these. You could probably go to bankrate.com, I think is the site that handles all that, that does the comparisons, is because of where the yield is coming from and what they're allowed to do with the balance sheet or customers' deposits, or there's a variety of things. And this is just in the US. Remember, banks are regulated not only at the federal level, but often at basically at the state level. They have not just one federal regulator, they have multiple federal regulators. They often have interactions with securities and commodities regulators too, both at the state and federal level. And so that yield gets, there's that juice, as it were, gets squeezed out for different reasons. The 4% comes from, or higher, comes from putting those deposits into what Alexis just mentioned, possible unregulated securities or unregistered securities. In some cases, it comes from they have the person you're depositing it with may go out and trade with that to generate their own yield and take a slice of it and give it back to you. There's different. There's not like one cookie cutter way of describing these. There's been lawsuits or cease and desist orders from New Jersey and Texas towards both BlockFi and Celsius, but those are centralized platforms. They're not decentralized. But putting all that aside for the moment, the idea of banks, what they can and can't do. Again, if you're going to complain at what they can and can't do, I think it's worth looking at Robinhood and what they proposed 2.5 years ago. They went out to the market saying, we're going to provide all of our customers 3% interest rate accounts. And they're doing it with, they said, we're going to have each of these accounts is going to be SIPC insured, not FDIC, SIPC. So they ended up having to walk that back almost immediately, because not only did the SIPC, the CEO of that, and other organizations involved in that whole the brokerage business say you can't do this, but the CEO basically learned that there's a reason why all these other brokerages weren't offering 3% or higher yields, and it's not because they're mean, horrible, organizations. It's just there's little like capital tiering of what you can do with customer deposits, and what those things are covered with. So they had to walk back to 3%, not because any Gary Gensler was trying to protect them from high yield products, because that's not what these accounts were structured for in the first place. So if you want to change things, that's fine. I'm not opposed to that whatsoever. Very, very much a fan of trying to sit down and find out things that are rational to potentially change. But you're coming in and complaining that everyone else is doing it. That's not particularly compelling. Everyone else is breaking the law, so should we. But to be fair, like if you want to compare it with banks, then let's actually compare it with banks. What are banks allowed to do with customer deposits, and why are the yields structured the way they are? And let's have that kind of conversation.
Banks have FDIC insurance, right? I don't know that it's right to compare a crypto lending product with a bank deposit, because bank deposits are FDIC insured. You will be able to get your money back in the event of something catastrophic happening. You don't have any protection like that in a crypto lending arrangement. So they're two sort of different things. And I'll just add two more risks. One is if you're doing a sort of a lending arrangement on DeFi, you're going to have to be subject to gas fees, right? So you're subject to putting the contract together, whether it's in a liquidity pool or a crypto lending arrangement, you're going to have to pay some gas fee, and depending on the congestion of the network, that might be very high. And the last thing, I know we're at time, is I feel like individual investors are now having to manage counterparty risk themselves and sort of monitor for solvency of the institution that they are doing this crypto lending with. And that is, that's, I think fairly new. I think a lot of other financial products, you're not sort of expected to manage the counterparty risk yourself, unless you're at an institutional desk, right? Like trading with other institutional clients.
Exactly. Well, thank you so much to both of you. We don't have any more time for questions. We could continue this conversation longer and longer. There will be a blog post following up and the recording of this talk posted. And it's been a fascinating discussion. We hope it was very helpful for the audience, and it's definitely been enjoyable for me. Thank you.
Thank you.